It seems like everywhere you look these days, there's talk of economic uncertainty, right?
Yeah, for sure.
Inflation is hitting everyone's wallets pretty hard, and there's this looming possibility of a recession.
Yeah, it's definitely a bit unnerving.
It can really make you question if you're truly prepared financially.
Absolutely.
So today, we're going to really dive deep into a topic that's super relevant right now. How to recession-proof your wallet.
It's something that's probably on a lot of people's minds.
Yeah, for good reason.
Yeah.
And with this deep dive, we really want to give you the tools and the knowledge to feel confident in taking control of your finances.
Exactly. It's all about building a solid financial strategy that works for you, regardless of what the economy throws your way.
Exactly. Our goal is not to bog you down with complex economic theories or jargon. We want to give you practical, actionable advice, real steps you can take,
Absolutely, yeah.
smart strategies, and even some mindset shifts that can make a huge difference. The aim is to equip you to navigate any potential economic turbulence out there without having to sacrifice your long-term financial goals.
Because those are important.
Definitely.
Yeah.
Our mission is to make sure you feel prepared, secure, and confident in your ability to weather any financial storm.
That's the goal.
So to kick things off, let's start with the basics. What exactly is a recession?
Well, in simple terms, a recession is basically a period of significant decline in economic activity. Think, reduced consumer spending,
Okay.
businesses becoming more cautious, and, yeah, unfortunately, a rise in unemployment.
So a general slowdown across the board. Got it. But what does being recession-proof actually mean for, the average person?
Right.
It's not like we can just become completely immune to it, right?
Yeah, that's a really important point. Being recession-proof isn't about being invincible.
Right.
It's more about building a really strong and resilient financial foundation. It's like, imagine building a house, a really sturdy house.
Right.
Having a strong foundation and solid construction won't necessarily stop a hurricane from happening,
Right.
but it'll significantly increase your chances of weathering that storm,
Right.
right? And protecting what's important inside. So it's about being prepared, having that financial cushion to help you safeguard your long-term goals.
Okay, that's a great analogy.
Yeah.
So it's all about putting your finances in order to be ready for those potential challenges.
Exactly.
I'm thinking things like, the possibility of job loss.
Yeah.
Maybe your small business takes a hit.
Right.
Or even your investments see a temporary decline.
Absolutely. All possibilities.
Being prepared means recognizing those risks and taking proactive steps now to soften the blow.
Exactly. We saw this play out pretty dramatically during the 2008 financial crisis.
Yeah.
Many people who weren't prepared faced really difficult situations.
Of course, yeah.
Losing homes, jobs, savings. It was a tough time.
It was a challenging period for a lot of people.
Yeah.
But I also remember seeing people who, despite those difficulties, seemed to manage much better.
Yeah.
What was it that set them apart?
Well, often it was the people who had already built up that financial resilience,
Okay.
Maybe they had a solid emergency fund.
Okay.
Perhaps they had diversified their income.
Okay.
Or they had a clear financial plan in place. Those folks were often able to weather the storm more effectively and bounce back quicker.
They had that cushion, that flexibility, and a strategy to guide them.
Exactly. Preparation makes a huge difference.
Okay, so the takeaway is clear. Being prepared is key. So let's get into the nitty-gritty. Let's talk about those practical, actionable steps that our listeners can start taking today to really solidify their financial positions.
Okay, sounds good.
Where should they begin?
Let's start with what many consider the cornerstone of any solid financial plan, your emergency fund.
The emergency fund.
This is your safety net.
Why is
It's
that?
there to catch you if unexpected expenses pop up, or if you face a sudden loss of income.
Absolutely. It's that financial buffer for those unexpected what-if moments in life. What would you say is a good target amount for people to aim for?
Well, a common recommendation is to have enough easily accessible savings to cover about 3 to 6 months of your essential living expenses.
Okay.
This gives you a crucial buffer if, let's say you were to face a job loss.
Right.
Or a major unexpected cost, like a medical emergency.
Yeah.
Now, I know that can seem like a pretty daunting goal, especially if you're starting from scratch.
Sure.
So if that feels overwhelming, a great starting point is to aim for a mini emergency fund of $1,000.
Okay.
That initial goal can feel a lot more achievable, and it'll still provide a valuable cushion for smaller emergencies.
Right. More manageable.
And here's a quick tip. Automate it.
Okay.
Set up a small weekly transfer, even if it's just $25.
Okay.
It adds up faster than you might think.
That makes it feel less overwhelming for sure. But can you really stress why having this emergency fund is so crucial, especially now?
It really boils down to avoiding the need to take on high-interest debt when life throws you a curveball.
Okay.
Imagine, you suddenly lose your job
Right.
or you get hit with a huge medical bill. Without an emergency fund, you might feel forced to rely on credit cards or take out loans.
Yeah.
And those can put you in a really precarious financial position, especially during an economic downturn when interest rates might be higher.
Right, because that debt just starts piling up.
Exactly. And it becomes harder to manage. That's why that 3 to 6 month buffer is so important. Think about it. If you were to lose your primary source of income tomorrow, having those savings means you have time to breathe.
Okay.
You can assess your options, look for new employment without that immediate panic of, how am I going to pay for basic necessities?
It's peace of mind and the ability to make clear-headed decisions rather than rushed ones.
Exactly. So once you've got that emergency fund in progress, the next crucial step is tackling debt, especially that high interest debt.
Ah, yes, debt. It can feel like such a burden, especially when the economic outlook is uncertain.
Yeah, it really can. During a recession, that high interest debt becomes an even heavier weight. You really want to prioritize minimizing those interest payments that eat away at your finances.
Definitely.
Focus on paying down things like credit card balances and high interest personal loans as quickly as possible.
And there are a couple of popular methods people use for tackling debt, right?
Right.
Like the debt snowball
Oh,
and
yeah.
the debt avalanche. Can you give us a quick rundown of those?
Sure. The debt snowball method is all about building momentum by knocking out those smaller debts first.
Okay.
You basically list your debts from the smallest balance to the largest, regardless of the interest rate, and focus all your extra payments on eliminating that smallest debt first.
Okay.
Once that's gone, you move on to the next smallest, and so on.
Okay.
The idea is that seeing a debt disappear completely can be really motivating and keep you going.
Those little wins.
Exactly. Now, the debt avalanche method, on the other hand, it's a bit more mathematically efficient.
Okay.
You list your debts from the highest interest rate to the lowest and prioritize paying off the debt that's costing you the most in interest first.
Makes sense.
So you're technically saving more money in the long run.
So ultimately, it comes down to finding the method that keeps you most engaged and committed to paying down that debt.
Exactly. It's about finding what works for you and sticking with it.
Now, we've got our emergency fund building. We're actively chipping away at that high-interest debt. What's the next step in building this financial fortress?
Well, it comes down to a fundamental principle: living below your means,
Okay, living below your means.
which simply means spending less than you earn.
Sounds simple enough.
It is, in theory.
Right, in theory.
But putting it into practice can be a bit more challenging.
Definitely, yeah.
But it's one of the most powerful ways to build overall financial resilience and free up some breathing room in your budget.
Where should people even start to try and make that happen?
The first step is really getting a clear picture of where your money is going each month. Track your expenses,
Okay.
write it down, use an app, whatever works for you.
Right.
But really understanding your spending habits can be really eye-opening.
Oh, yeah.
Once you have that awareness, it becomes much easier to make conscious choices about cutting back on unnecessary costs
Okay.
and start prioritizing your needs over your wants.
Right. You know those daily lattes from the fancy coffee shop? Or those subscription boxes you might not even use that much anymore?
Yeah, exactly.
Those seemingly small expenses can add up so quickly over time.
It's about those small, consistent changes that can lead to significant savings for you in the long run.
So it's about making intentional choices about your spending rather than just mindlessly swiping your card.
Exactly. And to really solidify this habit, the next highly effective step is to automate your savings.
Oh, automation. I love this.
It's a game changer.
It really is. It basically takes the willpower out of saving.
Exactly. Set up automatic transfers from your checking account to your savings account on each payday.
Oh.
Treat your savings contribution like any other essential bill.
Right.
This way, you're consistently paying yourself first.
Yeah.
And it greatly reduces the temptation to spend that money on things you don't really need.
So we've got our emergency fund growing. We're chipping away at that high-interest debt. We're living below our means and automating our savings. What's the next layer of defense we can build against a potential recession?
Now we move towards creating multiple streams of income.
Multiple income streams.
Okay. This is a powerful strategy for recession-proofing your finances. It's often overlooked, but it can make a huge difference.
Because if you're relying solely on one source of income and that source gets disrupted, well, you're in a vulnerable position.
Exactly. If one income stream takes a hit during a recession, you've got other sources to help you stay afloat.
It's about having a backup plan.
Exactly. Diversification is key.
So what are some tangible ways that people can start exploring this idea of multiple income streams?
Oh, there are so many possibilities. Side hustles are a great place to start. Think about your skills, your hobbies. What are you good at? Could you offer freelance services like writing or web design?
Okay.
Maybe you could tutor in a subject you excel at or sell handmade crafts online. There are endless possibilities.
It's about leveraging what you already know.
Exactly. And then there's passive income.
Passive income.
This is where you earn money even when you're not actively working. Things like rental income from a property, dividend payments from investments,
Okay.
or even creating and selling an online course, something you can set up once and potentially earn from repeatedly.
The online course example is a great one because it allows you to share your knowledge in a way that can reach a wide audience.
Exactly. And then there's upskilling.
Upskilling, okay.
This is about investing in yourself, learning new skills that can increase your earning potential.
Okay, so like taking online courses, workshops.
Yeah, exactly. It could be in your current field or something completely new that interests you.
And how does upskilling tie into creating multiple income streams?
Well, by acquiring new skills, you might be able to qualify for a higher paying job.
Okay.
Or you could offer new services as part of your side hustle. It's about expanding your options.
So the takeaway here is don't put all your eggs in one basket. The more diverse your income streams are, the more resilient you'll be to economic shifts.
Couldn't agree more.
Okay, so we've covered building a solid financial foundation, and we've explored ways to generate income from multiple sources. Now let's talk about investing, especially when the economic landscape feels so uncertain.
Yeah, this can be a tricky one.
It can be a bit nerve-wracking. During a recession, it's common to see market downturns, and the natural reaction for many is to panic and sell off investments.
Absolutely. It's an emotional response.
But historical data tells us that the market tends to recover and grow over the long term.
It always has.
So it's about keeping that long-term perspective in mind, even when it's tough.
Exactly. Don't get caught up in trying to time the market, trying to predict those short-term fluctuations.
Right.
It's incredibly difficult to do, even for seasoned professionals.
Right.
Instead, focus on developing a sound, long-term investing strategy.
So what are some key principles our listeners should keep in mind when it comes to investing during uncertain times?
Well, first and foremost, diversification.
Okay, diversification.
Don't put all your money in one place. Spread your investments across different types of assets.
Okay, like stocks, bonds.
Exactly. Real estate, maybe even commodities. The idea is that if one sector takes a hit, others might hold their value or even perform well, balancing out your overall portfolio.
So it's like applying that principle of income diversification to your investments.
Exactly. If the stock market is down, your bond investments might be stable.
Got it.
Another strategy is to consider investing in industries that tend to be more recession resistant.
Recession resistant, okay.
These are sectors that provide essential goods and services that people will continue to need regardless of the economy.
Okay, like what?
Healthcare,
Ah.
utilities, consumer staples, things like food, basic household products. People still need those things, whether the economy is booming or not.
Makes sense. You're still going to need to go to the doctor, keep the lights on, and buy groceries.
Exactly. And then, of course, we come back to maintaining that long-term perspective.
Right, keeping your eye on the price.
Exactly. It's so crucial not to get swept up in the short-term volatility of the market.
Yeah.
Remember your long-term goals and try to avoid making impulsive decisions based on fear or temporary dips.
It can be so tempting to panic and sell when you see things going down.
I know, but it's often the worst thing you can do. The market has a history of recovering, and often the best strategy is to ride out those waves and stay the course.
So patience is key.
Absolutely. And another tip, consider dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of whether the market is up or down.
Okay,
This can help you avoid buying high and potentially get more shares when prices are lower.
that's smart.
Also, during downturns, it's a good time to review your portfolio and see if it needs rebalancing.
Okay.
This means selling assets that have performed well and buying more of those that have declined, which can help keep you on track with your target asset allocation.
So what would you say to someone who feels completely lost when it comes to investing? They don't even know where to begin.
If you're feeling overwhelmed or unsure, seeking guidance from a qualified financial advisor can be invaluable.
Okay.
They can help you develop a personalized plan that aligns with your goals, your risk tolerance, and your time horizon.
So, get some expert advice. Okay, we've talked about saving, increasing income, investing strategically. Now let's shift gears a bit and talk about protecting the assets you've already built.
Absolutely. It's just as important as growing your assets.
So, what are the key areas we should be thinking about when it comes to protecting our hard-earned money?
Well, first and foremost is insurance.
Okay, insurance.
Make sure you have adequate health insurance, life insurance, and disability insurance.
These are things people often don't want to think about.
I know, but they're so important. Unexpected health issues, the loss of a loved one who provides income, or becoming unable to work due to illness or injury can devastate you financially if you're not properly insured.
These are realities we need to be prepared for. Can you give us some specific examples of how each type of insurance offers protection?
Sure. Health insurance helps you manage medical expenses, which can be astronomical, especially for major procedures or long-term care.
Right.
Life insurance provides financial support for your loved ones if you were to pass away.
Okay.
It can help cover things like mortgage payments, living expenses, and even future education costs for your children.
Okay.
And disability insurance replaces a portion of your income if you become unable to work because of an illness or injury.
Right, so you can still cover your essential expenses.
Exactly. It ensures that you can continue to pay your bills and maintain your standard of living.
These are essential safety nets to have. What's next?
Next is estate planning.
Estate planning.
Now, this might seem like something only for the wealthy or elderly,
Okay.
but having a will and a power of attorney is important for everyone,
Right.
no matter your age or net worth. These legal documents make sure that your assets are protected and distributed according to your wishes if something unexpected happens.
It really helps to ease the burden on your family during a difficult time.
Exactly. And it can help avoid lengthy legal battles and potentially costly probate processes.
Makes sense.
A power of attorney is also essential.
Okay.
This designates someone you trust to make financial and medical decisions on your behalf if you become incapacitated and unable to do so yourself.
So you're covered in case of an emergency.
Exactly. These are crucial pieces of the financial security puzzle.
Definitely. And finally, you mentioned the importance of being wary of scams.
Right.
Why is this particularly relevant during times of economic uncertainty?
Well, sadly, economic downturns often see a surge in financial scams. Scammers prey on people's anxieties, offering these get-rich-quick schemes or promises of easy money when people are feeling vulnerable.
Right.
It's so important to be extra cautious, do your research thoroughly, and be very suspicious of anything that sounds too good to be true.
It's heartbreaking when people lose their hard-earned money to these scams.
Absolutely. Protecting your money is just as important as growing it.
So vigilance is key. We've covered a lot of practical steps today, but let's also talk about something less tangible but equally important. Our mindset when it comes to our finances, especially during challenging economic times.
You're absolutely right. Financial resilience isn't just about the numbers in your bank account. It's also about your attitude towards money
Okay.
and your ability to handle financial stress and uncertainty.
So what are some key mindset shifts that can help us navigate a recession with more strength and clarity?
One of the most empowering things you can do is focus on what you can control. Economic downturns can feel overwhelming, and it's easy to fixate on things like the stock market or the job market, things that are largely out of your control.
Right.
Instead, channel your energy into things you can manage.
Okay, like what?
Your spending habits,
Okay.
your savings rate, your commitment to learning new skills.
Right, focusing on your own actions.
Exactly. Take proactive steps to improve your situation.
Makes sense. So what's another helpful mindset shift?
Embrace intentional frugality.
Okay, intentional frugality.
This isn't about being cheap, it's about being mindful and deliberate about where your money goes.
Okay.
Making conscious choices about your spending based on your values and priorities, not just impulse buys.
It's about making your money work for you.
Exactly. And finally, cultivate a sense of realistic optimism.
Realistic optimism.
It's okay to feel some concern during tough times, but remember that economic downturns are usually temporary. Maintaining a positive outlook while still being realistic can really help you navigate challenges and come out stronger on the other side.
That makes sense. So focusing on what we can control, being intentional with our spending, and staying optimistic, those are all powerful mindset tools.
Absolutely. Your mindset plays a huge role in how you approach and handle financial challenges.
Okay, so we've covered a lot of ground today. Let's recap the key takeaways.
Sounds good.
We talked about the importance of preparation, protecting what you have, and the role of a resilient mindset in recession-proofing your wallet.
Exactly.
So, to summarize, it starts with building a strong financial foundation.
Yeah.
Establish a solid emergency fund, tackle that high-interest debt.
You're right.
Look for opportunities to create multiple income streams to bolster your financial security.
Absolutely.
Adopt a long-term perspective when it comes to investing, even when things feel uncertain.
It's about the long game.
And protect what you've worked for with adequate insurance and estate planning, all while cultivating a proactive, adaptable, and optimistic financial mindset.
It's all interconnected.
By implementing these strategies, you can navigate economic uncertainty with more confidence and peace of mind.
You can weather the storm and even potentially thrive in the long run.
So as you think about all the strategies we've explored today, from starting that emergency fund to exploring new income avenues and investing wisely, what's one concrete action you feel most empowered to take right now?
What's that first step you can take today?
Take a moment to consider that. What small change can you make to strengthen your financial resilience? Thank you so much for joining us for this deep dive.
We hope you found it valuable.
Until next time.
Take care.